for base metals. Now, in today's session, I think we will take a closer look at exchange traded derivatives, and I'll try to also highlight the different trading techniques that market participants employ on the futures market. The general idea, I think, would be how can I actually help to highlight and accentuate these potential trading opportunities on the non-ferrous market. I went through actually the feedback from the first webinar and actually concluded that the viewership interest is relatively centered within speculative opportunities. So on this, I think I'll cover more on outright trades. I'll try to give some insights on spread trading, both intra and intermarket. Okay, I think without further ado, let's get started, and I hope that all of you can have some good takeaways after tonight's session. One more thing, I think there's the question box. If you have any questions, you can just type it in, and then I think at the end of the webinar, we'll do a Q&A, and I'll try my best to address them. Thank you. So as always, this is our presentation disclaimer. Kindly note that the content prepared here is an expression of belief on research done by myself on the subject matter. So in a nutshell, if you're uncertain or you have any queries, right, please feel free to post them, post-event even in the chat, or even actually you can write me an email. We'll do our best to assist you accordingly. As for the presentation agenda, I think the narrative is relatively simple. There'll be 4 segments covered. I'll take about 45 minutes to cover all 4 of them, and then I think the last 15 minutes we'll leave it for Q&A. So we'll do a little recap from part 1. I'll do a quick run through where we will actually focus more on the listed derivatives in the non-ferrous marketplace. I will give some actually simple illustrations of an outright trade in the futures market and actually how market participants participate in this. And then also I'll just run through briefly the contract specs on base metal futures. I guess this will help some of our viewers who are new to leverage trading. Next, of course, we'll look at outright trades for base metals. I think how some market participants actually touch on speculative opportunities, how do they trade headlines, what are the fundamentals to look out for. And the second segment, within the second segment actually, we'll cover technical analysis on various non-ferrous metal contracts. Try to see actually how people deploy or actually employ technical analysis to actually trade the market. Yes, so in a nutshell, this is actually to showcase trading strategies. I think the third one is on spread trading 101, where we'll take a closer look at intra-market, basically calendar spreads, and also inter-commodity spreads. I'll touch more on the concept behind spread trading, as I understand some of our guests are relatively new. And also I'll do some simple illustration as always to actually show the point. Lastly, of course, we look at product highlights. We show some of the key product developments that has happened in the non-ferrous space. I'll highlight some of the technical portions of the base metal contracts, the specs, etc., and why actually investors can utilize exchange traded derivatives to discover prices in the non-ferrous space. Of course, Q&A will follow short after. Thereafter, I mean. Okay. So actually, how can traders discover prices for base metals? There are actually 4 main markets, and within them, there's actually the spot market, OTC, and also there's the exchange market, the forward market, and lastly, the futures market. So you will see actually there are actually 4 main exchanges. If we focus on exchange traded derivatives, we have, of course, US, the COMEX group, where they have the copper and the aluminium. We have, of course, China, SHFE, the Shanghai Futures Exchange, where they house all 6 of the base metal contracts. And of course, lastly, we have thirdly, we have the London Metal Exchange, the World Center for Industrial Metals Trading. I think the benchmark is used as a benchmark between the metal and investment communities. And lastly, we have Hong Kong Exchange, the Asian benchmark, where they actually help to connect Asia towards the LME. So actually, there's a new London Metal mini contracts that was launched actually in 2019. All 4 exchanges actually house the non-ferrous metals suite. Actually, the LME, I think, is highly liquid, and market participants actually stand to benefit from a thick order book. As you can see, the copper, the aluminium, the aluminium is actually the most liquid base metal contract that we see in the world, actually globally. Theirs is actually a 3-month rolling forward contract for all 6 of the base metals. They also have a futures contract and forward contracts as well. On ferrous, which is like iron ore, steel, hot rolled coil, and they also actually have a precious metal suite. For Hong Kong Exchange, of course, they house actually 6 base metal contracts, which are denominated in both CNH and also the US dollar. So the US dollar, which is the one that is liquid, actually allows investors to take advantage of a mini and futurized variation of the LME base metal contract. That is because the OSP and the settlement price is derived from the LME's third Wednesday prices, settlement price. So of course, there's some benefits because it allows Asian market participants to mitigate price risk in the Hong Kong time zone. COMEX, of course, they house both copper and aluminium. The COMEX high-grade copper is extremely liquid. I think it's known in the marketplace. For SHIFI, all the contracts are really liquid, but I think it's still very restricted to domestic access, and the prices are denominated in renminbi. Right, there's a lot of retail participants as well as we see in the SHIFI. Okay, I think I will share a bit on the market participants for non-ferrous metals so that we can have an overview on why people actually trade the non-ferrous, the base metal contracts. So actually there's two primary client segments that you can see. One of course is the physical players, and the other I just term them as the speculative market forces. So I think you have, on one hand, you have the commodity traders who are seeking to hedge their price exposures in lieu of their primary business activities. And on the second hand, you have the props, the funds, the retail investor who are looking to trade it as an investment asset or make a speculative play on prices. Now, both parties can also seek, I think, arbitraging opportunities in the physical or paper markets. They're looking for some efficiencies due to prices or geographical disconnect. So I think all this can be caused by many examples, like even exchange rate fluctuations or even cross-exchange pricing can actually give you an opportunity. I'll try to show you more later in the examples when I show some examples of the spread. Okay, I think this is just an example that I wish to show of a speculative play on copper prices. So as you can see here, this is actually a candlestick chart, the day chart. I've actually put up the LME 3-month copper rolling forward in the form of candlestick, and I've also put up the Hong Kong Exchange London Mini Copper Futures. So you can, as you can see, right, both prices actually track the one another very closely. They have a very strong correlation, and prices tend to move in tandem. Now we believe that of course traders can actually exploit speculative opportunity via technical analysis. So as you can see here, it's a very strong uptrend. We see higher highs being made over here. So I think the example that I'm trying to show over here is that actually you can see that actually traders do deploy technical analysis on one hand to actually trade the non-ferrous market. Again, we see here some form of rejection towards the downside, and of course, it's trading fairly nicely upwards. So I think if we look, if we assume, for example, I think if we assume that if the trader actually employ a buy on dip strategy, as they believe copper prices to be on uptrend, they might actually deploy limit orders right along the trend line to take advantage of the mean reversion and also the momentum in asset price. So this is just an example. I want to illustrate my point over here. So assuming that you employ technical analysis, I think you believe in the trend trading and you feel that there's some upside potential for copper prices, the trader might decide to go long. So in 13 August, for example, like this, you can see the timeline over here, it's about 13 August. Actually, he decides to buy 2 contracts, the Hong Kong Exchange London Copper Mini Futures. The price is about 6250 per ton. Contract size 5 ton. The margin that you need to start the trade is around 2,234. So if you look at 2 contracts, it's about 4,468. So this is the minimum outlay you need to initiate the contract. If we move forward, assume we make some assumptions on 19 August, actually, the price start to move higher and it's trading at 6,700. If you decide to unwind your position at that point of time, your unrealized profit is about 450 per ton. So this was how your P&L will look like. 450 times 5, and then of course, then total net profit, right? It's 4,500 because of 2 contracts. Of course, we need to note that risk and reward is always in tandem, but this is an example of how traders actually deploy technical analysis and actually trade outright on copper futures. So I'm just going to briefly skim through this. So how can you actually get access to ETDs and actually trade the base metal contracts? There's several ways. One, of course, is the LME 3-month rolling forward. You can see over here, there's of course aluminium, there's nickel, there's lead, tin, and of course zinc. So even you can see here, it's 25 metric tons. Delivery type is physically settled. The minimum tick value is 50 cents per metric ton. So per tick, your profit and loss is about, let me see, your profit and loss will be about 12.50. Yes, the recording will be shared thereafter because I just saw a question pop in. And okay, moving on, the contract period is 3 months, actually up to 3 months. Initial margin is about 10,400, and Aluminium is at 2,460. So if you look at the USD, a London Metal Mini Futures contract, it's actually a standardized futures cash settled contract. The ratio is 1:5. It's 5 times smaller than the LME 3-month rolling forward contract. It's also denominated USD. The profit and loss is about tick value is about 250 and about $1 for nickel. So the ratio is just 1:5, 5 times smaller. It's it's miniature, it's a miniature contract, so that actually traders, can go in with a smaller capital outlay. So you can see copper is 2,234, but for aluminium and zinc it's slightly lesser, 566 and 863. I think the key difference between both contracts is that one is futures standardized, the other is forward. It's a forward contract that's physical, it requires physical delivery. The key benefits, of course, of future contract, as I said before, is that you have lesser, I think, market and credit risk because it's exchange traded and there's the reduced counterparty risk. I think this is just an example, right, that I wish to illustrate, right, why or actually players actually take advantage of the futures market and why do they participate. So for commodity players, of course, it's risk management. You get to manage risk on flat price. It allows you to actually mitigate price exposures, fluctuations in commodity prices that are very volatile because of geopolitical and also economic uncertainties. You can, of course, lock in a worst case scenario price to actually reduce your potential losses. I think in post-COVID and pre-COVID, actually, we have really seen huge gyrations and fluctuation in the prices. And of course, this has a huge impact to the balance sheet of commercial players. Next, I think on a more speculative note, I think you can, of course, trade risk and take advantage of market-based considerations. So in the futures market, for example, you get capital efficiencies from leverage trading. You can speculate on the price action and actually take advantage of what's happening in the market. And most importantly, you can establish a bi-directional view, go both long and short. So even in times like this, right, where geopolitical and economic uncertainties are creating all this fluctuation in price, I think you see certain, you can actually trade risk, you can actually manage risk, you can actually sell into the market to lock prices. And lastly, of course, you can look at intra-market inter-commodity spread trades. So I think this is a little different. It's not so much directional. You allow the traders to take advantage of basis trades. You are actually more focused on the change in the relationship between two contract months for calendar spread. So I think this I'll share a bit more later. I'll show you. I have prepared some examples actually. For intercom spreads that we are looking at over here, I think it's a bit more complex, where you actually involve a simultaneous buying and selling of two different but related futures with the same contract month. So actually traders are actually trading off the relationship, and you can actually express your views through the spread, which I'll also show later on. Okay, so now I think we will go a bit deeper. We'll look outright. Okay. So actually, I think what drives prices, right, or rather what shapes prices for base metals? So of course, in the first thing, I prepared actually 5 key points, I think just to illustrate my point. So of course, market fundamentals, the first is always demand. We always look at the Chinese story, because I think China continues to act as the most important variable for industrial metals. I think we have to understand that China actually accounts for more than 40% of purchases for aluminium, copper, 2/3 of the world's production of iron ore as well. China actually buys a huge portion of raw materials and actually exports them out. I think more than 1/3 of them is actually exported out there into global markets. Copper, aluminium, zinc, and everything all have a very strong correlation to China because of this. And of course, all these key economic indicators like the GDP, the Caixin China manufacturing PMI, industrial production, industrial profits, manufacturing PMI, all these are integral in boosting the risk sentiment for base metals. So you can see also actually as the copper prices, for example, has been rallied. We see a lot of pent-up demand post-COVID. There's the effect of stimuluses from the government and also strong resilient exports. All these help to boost prices and actually economic activity. I'll show you some examples later on. Next, if you look at, for example, market supply of base metals, we're looking on the supply side of things. I think Latin America is still one of the most important variable for copper. Although China still continues to dominate, I think, consumption and purchases for aluminum. For nickel, for example, I think the emergence of EVs and green policy, has helped to boost prices on this. So I think you can also check, I think, the global mine production, refined production levels, inventory data. All these, I think, traders actually study the positioning on LME to determine future trends on the fundamental portion. Next, of course, we look at global economic releases, which also helps to actually shape and make sentiment. I think if you see global GDP, even interest rates and everything, all these have a strong correlation. I think that's because base metal, of course, is fundamentally an industrial item and it has a huge commercial application around the world. So all this weakness in economic data or strength will actually reflect certain utilization of commodities and help to either affect, boost, or actually depress prices. So it's a two-way street, basically. So next, I think I summarize my point. I think this is something that I want to touch on a bit more. Geopolitical risks and events. I think this is likely to actually cause a lot of short-term volatility. So you've seen, of course, the U.S.-China trade relations. I think now is the U.S. Jackson Hole meeting actually coming tonight, but it will be on Zoom. Sorry, not Zoom. I mean, it's on goes digital. They're not meeting at Wyoming. Of course, export and import restrictions on countries that actually produce or actually purchase a lot of commodity. This will also affect actually the prices. Basically, news-driven trading activities. All this will actually help to drive trading and actually move prices very fast and aggressively as investors all move to take on speculative stances. I think I've summarized these 3 points. I think these are the three likely points that will shape the overall market sentiment for prices in base metal as you move on in 2021 is the US election in November. The coronavirus outbreak which actually shaped prices in the first part and what's going to happen next. And of course some of the Fed meeting as we look at it, the interest rates, where is it going? Okay, I think I was asked by some of them to show actually some key examples of how the economic indicators actually affected copper futures. So I've actually put up two PMIs, both the Caixin and the China manufacturing PMI. So from here, you can see the relevance of key economic indicators for China. You can see, for example, the sharp decline that was seen after the PMIs were released actually in February. It continued to decline all the way to March before it finds two bottoms, the rule of two. We can see, of course, that's the reason because there's a very sharp contraction. It's because countries lock borders, they cease industrial activities in China. So all this actually helped to actually push prices to actually sell off actually. So of course we saw the rebound. I think copper price actually found some support, but it really started to push up after the second quarter. That is because I think we saw the supply shock in South Africa, Peru, and Zambia. I think we saw positive economic data going back again to key levels. And of course, mining companies have also put off, I think, investment in new mining operations until I think we are able to shake off, I think, COVID-19 concerns and, see stronger demand in the coming term. So I think I think we are expecting, of course, the Chinese GDP is expected to turn positive after 2Q, in the second quarter, after the 6.8% contraction we saw in first quarter. So I think you can see over here, the main point is the economic indicators, how it actually drives prices, especially China. It's very apparent here. So if we look at the next one, this is LME Aluminium 3-month rolling forward, along with the Hong Kong Exchange London Aluminium Mini Futures. This time around, I just put up the Caixin as well. So actually, we are seeing the same conditions as copper. Not much difference. However, there's an additional factor that we saw in 2019, which is the US-China trade tensions. I think the bilateral trade relations was really a key catalyst in the aluminum market as political tensions really escalated. Of course, the demand was hurt more than expected. China being one of the largest producer and also consumer of metal, I think we saw prices really tilted as markets quite uncertain. But now I think post-pandemic, or like to say, after, we're not out of the woods yet, but things are getting a little better, sentiments recovering. I think we've seen a recovery in Chinese demand and industrial activities. This has really helped to boost prices. So I would say that traders, you should of course stay cautious of the POTUS 2020. I think if we see a resurgence in protectionist agenda, this is going to negatively affect aluminum prices, I think at least to the end of 2020. Okay, I'll just share very briefly, actually how, there's nickel, zinc, lead, and tin perform in 2020. I think the story is relatively similar. The trajectory is not much of a difference, although we see a little curve for some of them, like maybe tin. Nickel, I think, is still very vulnerable. We saw a 9-month high actually in August. I think prices actually increased by 8% month on month. Of course, the China economic recovery, the strong demand because of the stainless steel industry and industrial activity and profits have helped to boost nickel prices. But still, we feel that it's very susceptible, I think, to market volatility. Nickel's over here in blue, for those of you might know. I think EVs and the stainless steel industry will still continue to drive prices. The trajectory seems to be a very long-term bullish ones, but I think we should be ready to be prepared, that I think market volatility might really hit the market anytime. As for zinc, if we look at it, right, I think we see recently the news came out that there's a supply disruption in Bolivia. I think post-COVID, stainless steel demand going up has been very supportive for prices. So I think in the long term, I think we have to note that that the zinc is still quite susceptible to a reversal. I think if we see the geopolitical situation and the production actually changes. So next, if we look at lead, for example, as I spoken out the last time, I think we still see very range-bound conditions. I think for lead, I think we don't think the prices might go up too much. U.S.-China trade tensions, of course, is one of the things that might affect prices, of course. And tin, of course, I think in the it's a long-term game. I think long-term, some people are saying that tin might look good. I think that's because we see that there might be the new commercial applications, the rollout of 5G networks and telecommunications is likely to actually be supportive for demand. On the supply side, I think we continue to look at China, Indonesia, and Malaysia. So I think tin, the long-term outlook is good, but short-term, maybe we might see a bit rangy, a bit whippy kind of conditions. That's what we think. Okay, I think I just put this out. I think for our viewers to just mindful remember, you can actually get it off LME. So you can see, for example, copper, right? The Latin America is one of the huge component of copper production. You can see, of course, purchases, cost, and consumption actually is really dominated by Asia and mainly China, actually. Aluminium, of course, you see the biggest production is still China, consumption is still China, but the US, that's also one of the things they consume actually a lot from China. So that's why the US-China trade tensions actually have quite an effect on the market. So yeah. Okay, so if we look carefully at this on technical analysis, for example, for copper futures, we move a bit past market fundamentals. I just wish to highlight actually 4 simple illustrations to actually showcase how traders actually deploy different techniques or studies, right, to trade off base metal prices. So technical analysts are a little different. They do not believe in, rather they believe that past trading activities, right, and the price changes of the underlying assets are the future indicators of the price movement. So in the first illustration, I actually put up RSI actually to show you. I think you can actually use a MACD or you can use a stochastic oscillator to actually determine trend indication. So you can see the high and low band over here. So what I did was try to show I draw out certain levels that I see, certain points of resistance and certain points of support. So as we can see over here on the first line, we see copper prices look very whippy and extremely range bound. So we can see over here, if you use the oscillators to your advantage, you might see that prices look a bit, there's closing the oversold levels. And we see some form of rejection, and that's where I think traders start to take advantage of the situation. They unwind their shorts and also start to buy. So we can see as well here is overbought conditions, right, where they tested the resistance level over here. So you can see actually traders actually do deploy technical analysis sorry, to trade this. So you see from the examples over here. So if you look at the immediate term, right, we're seeing some weakness as well as price starting to turn. So I think, in a 4-hour candlestick, I think this was taken on the 21st. I think we can see, if prices are continue to respect the levels and are momentum driven, right, in this sense, I think it's likely, to take a movement down south. So I think the whole illustration is meant to show that actually, the prices are actually quite momentum driven. I think traders actually deploy technical analysis to find out their entry and exit points. Because they're expecting, for example, they might unwind their positions after a certain point. So next for this, right, I've actually put up the second illustration. I put up actually a Fibonacci chart. So you can see, for example, the yellow lines are actually the Hong Kong Exchange aluminum prices. And of course, the candlestick is the LME 3-month rolling forward. As you can see, once again, trajectory is moving together in tandem. Little gaps though, but in tandem. So of course, you can see I actually put it, this is actually close to a 1-year chart. I put it from the previous high actually to the lowest point. So for those of you who are new to this, right, the Fibonacci retracement levels are actually horizontal line that indicate where support and resistance are likely to occur All these are based on numbers, Fibonacci numbers, and are associated with a percentage. So the percentage is actually is on how a prior move, right, actually causes price to retrace. So you can see over here, you can see I like to say is the rule of two. You see twice, right? Twice rejection, you can call it double top, or even a double bottom here, where price start to find some support. But there will be momentum traders, for example, who take advantage of the situation when they see a certain break in prices, they'll push it down and there's certain test. So they might be, it determines if there's a sustained break, the prices will most likely target the next level. If not, they'll maybe repeat conditions before they attempt the next resistance level. So you can see actually, right, prices tend to when you test the Fibonacci chart on some of the prices, you see some level of respect. They actually respect certain key levels, actually on several occasions. So I think a market view can also be used to be expressed on prices using the Fib chart. I think momentum traders love to use this to zero in on key levels for the trades. So in this instance, right, if you look at it closely, I think the next resistance for aluminium, if I might say, looks to be at the psychological level, or even way before. Then of course support level seems to be at 1744, where we see some support over here. If it does have a sustained break, maybe momentum driven, it might even reach this level. Okay, for zinc, this time around, I've actually put up a Fib chart as well as the RSI. So I think how traders actually use both the oscillator and the Fib to actually complement, right, or actually supplement their viewpoint. So you can see if you have a certain view on price action, you can see that prices, I think, tend to move in tandem. So as it flirts with the oversold level, right, you find some support at the bottom. I think it flirts with the overbought level, sorry, over here, and it flirts with the support level, actually the key psychological level of 2000. This zinc prices, once again, rolling LME rolling forward, and of course the zinc futures. So I think one way traders can actually utilize this is, of course, to determine your take profit point. I think you might think that prices might retrace. I think selling activity, people might actually close out their position, start to take profit, or so this is where actually this is how traders can utilize both the oscillator and the Fib chart. Lastly, I think on nickel prices, right, I think it's a beautiful trend. It's an uptrend actually, right? We can see a very strong bullish trend. That's why I managed to draw the trend lines, actually touched twice over here. And I also put up actually the RSI just as an example, right, to show how actually prices move. This is a day candlestick chart, actually, a longer time frame, longer trading horizon. This is trend trading. It's actually deployed, for example, if you feel that prices will continue to move or make higher highs in this case. Actually, how traders use it to take advantage of an momentum in the asset. So of course, trend trading, I think the assumption is always that the securities will continue to move in the same direction that it's trending right now. So I think there might be stop losses, out of the trend, or there might be take profit at a certain angle. So in this case, we see prices tend to really, really respect the levels, although we see some weakness over here. But yes, even over here. So I think in this instant, if those who are trading trends, they might actually take a short. But I think if we believe it's an uptrend, the safer outlook would be to maybe buy on dips, or see if they're able to sustain. If it's able to sustain this level, so that's how actually traders do it. I think it depends how you wish to utilize this. You can actually take advantage of the bandwidth to trade a reversion of prices. This of course a longer time frame, but some people use it in the shorter time frame. Okay, I think next I will go in more. I'll touch more on spreads. So I understand that some of our viewers might not be that familiar with spread trading. So I think I wish to say that, of course, spread trading is widely utilized actually in the futures market. So there are some actually key advantage against the outright futures contract. Outright is more like the ones that we're talking about, technical analysis on trading headlines, etc. So this is because I think even in the base metal markets, there are strong correlations, with economic links and fundamental drivers. So what is the general idea of a spread trade? So a spread trade actually is a simultaneous purchase or sales, right, of two futures contracts. So basically you buy and you sell concurrently. So why do actually traders do this instead of taking an outright position, a directional position? What they're looking at is actually the price difference, and they're looking to take advantage of a relative value inversions, basically a mean reversion. So what are some of the benefits? It actually help to lower risk as compared to outright trades, because you're buying, for example, a near month and you're selling a far month for a bull calendar spread. and the bear calendar spread is the other way. So it helps to actually insulate you against very short-term intense volatility, right? In the spot month. So I think if you are really trading risk, the outright on the front month is always the one of the best chance to capture opportunity. But for those maybe who want to achieve maybe a superior risk-adjusted return, spreads is actually what they look at. So two kinds, once again, intra-market spreads, you can call them calendar spread, same contract, just different months. They speculate on the basis, basically the price difference. Intercom spread is a bit different. You actually require two different contracts, right, with a similar underlying asset. It can be, for example, the base metal contracts in LME against the base metal contract in Hong Kong Exchange. That's one of them. So what's the goal actually, you ask? So this is, as I said, right, is to the benefit between the price difference between both contracts. You need to look at the relationship, actually study them. So actually people will actually look on the correlation, maybe the contract spec, how does the price actually settle, and how does is there any anomaly to the prices? That's where they'll take advantage of the situation. So I actually did an example over here to try to showcase the relationship, right? So of the commodity curve. So this is just something that I did, a simple illustration, right? That is so that you can have a better understanding of the commodity curve. I think the first thing that we have to note is contango and backwardation. So when we look, for example, and I use this Hong Kong Exchange London Mini Copper as an example. You can see, right, we will see this in this case where the front month is trading at a low price. It is contango. This reflects the cost of carry and the interest and storage, cost of storage needed. So the commodity is more expensive at the backward month. So when the forward price of futures contract is higher than the spot price, this is called a contango curve structure. So when of course the spot price is trading at a premium, which that means, for example, in September is trading higher than October, that is a backwardation market. So it's actually the inverse. So some examples where backwardation occurs is when there's a very strong surge in demand or a supply shock in the immediate month. So that actually affects backwardation, what we call a flip in the commodity curve. So in this case, assuming that we are trying to do a curve spread trade, we look at the different and the various calendar months. We notice, for example, that the difference between the prices, right, each month tends to be around 30 or 20. However, we feel that it's an anomaly that actually in the November contract is priced as $50 more than the October contract. So we feel that, actually prices tend to revert back to the mean, which maybe is about like $30. So that is where the trader might actually enter into a spread trade. So they will look at the basis, right, and they will actually make certain assumptions. So that is how they exploit the trading strategies. So for Hong Kong, in the case of Hong Kong Exchange, the prices are priced all the way to 12 months. So we have a few assumptions, of course. Traders can study the historical data over the years. They'll look for correlations, similar patterns to determine this basis. What is this difference? This called basis. So when they spot a certain misprice, which can be for various reasons, it can be the market just moves faster than one another. It can also be because I think prices just someone came in and actually effected a strong trade in the front month. So this is where he will actually effect. In this case, he assumed that basis will remain to $30. Okay, why 30, right? It's because you take the front month and you deduct the second month. So in this case, $30 between. So imagine you take September month, you deduct October month. That's where you get negative 30. So in this case, this 6,700 minus 6,750, you get 50. So actually, what happens? How do you actually execute a bull calendar spread? So in this case, right, the proprietary trader actually takes a view that the October 20th contract is actually mispriced against the November 20th contract. He then executes a bull calendar spread by purchasing. He goes long on October 20. He shorts the November 20th contract simultaneously on 5th August. So we see, for example, this is the price difference. So once you execute, you actually have two positions. You have one open long in October and one open short in November. So 2 days later, if we look at the assumption, right, we notice that, okay, the price starting to come down. So there's a price difference. Actually, it's starting to close up in his favor. It's moving towards, for example, negative 30. So he decides to unwind his position. What he will do is he will close off his October position. And in this case, right, where the October prices have moved to 6,740 and he has long at 6,700, he gains a $200 profit. because he has $40 difference against 5 tons. And in the November contract, right, he's actually losing money because he actually sold at 6,750 and he went up to 6,770. But if you look, right, it will always be one position who is in a profit and one position in a loss. And the idea is that the earnings, right, will outweigh the losses. That's a spread trade. So your one leg will be making money and the other leg will not be. So this is also another illustration, right, now after 2 days, for example, how actually the prices move back. So you can see if we assume that the basis is all the same, actually it goes back to 30. So traders actually looking, once the prices start to recover, right, that is where he will actually close out his position in this case. So I think for example, the example that I showed earlier on is bull calendar spread. So what it means is you go long on the nearer futures contract month and you short the longer term futures contract. A bear spread is the inverse, where actually it is like something like this case where you sell or short the near term contract and you buy the longer term contract. That is the bear spread. So I just want to show you some simple illustrations, right, on intra-market spread. So as I said, these are calendar spreads. So you can see I took out actually a July copper, London mini copper against August London mini copper. So the time frame we've seen, right, is April to June. June actually where the July contract starts to expire actually soon. No, actually I mean July is expiry, but actually I just put out this time frame between April to 30th. So you can see, for example, I put out a line, for example. So this may be like I assume that that is the midpoint, right? So after you see, for example, you see certain anomalies, we believe that prices, the spread tends to revert back to around, I think, 5 or rather 650. For example, when you reaches 13, right, traders might move in to take a position. They might buy one side and they sell the other. So the idea between the spread, right, is to actually look at historical data, capture spikes and very irregular movements, and then execute your bull or bear spread to capture the opportunity. In this case, right, how do we do it actually? So we actually you can observe and study the historical spread difference. I think we try to construct some sort of upper bound and lower bound in this case, right? So actually you take advantage, so you might actually buy at the low point and actually sell at the far point. So once it reverts back to the mean, we start to unwind the position. That is how actually traders take advantage of it. So you can see it's actually quite apparent. For example, even in aluminium contract, right, you do see a certain sort of anomaly. So 1150, I just constructed a line just for reference, right? This is the same thing, July against August for aluminium. So you can see there's a low, for example, it tends to revert, and if it goes upright, it tends to come down as well. So I think you take advantage of certain spikes. That is how the illustration is. So for zinc, I think relatively the same as well. You can see, I think this is the negative point. So if we assume, for example, right, that we believe in the cost of carry, that the market is in contango, where the front month is supposed to be slightly, the back month is trading at a premium as compared to the front month. So when you see it's closed up so close to zero, right, practically the same price, I think that is where what you will do is actually you might actually buy the front and sell the back. And then you might unwind your positions, I think, the moment when you see like certain anomalies like negative 350, that's where you start to unwind. For nickel, I think it's relatively the same. We're trying to see the same thing as well, July against August. So as what I said, right, you're trying to catch this little spikes, trying to determine the upper lower bound, and from there, unwind your positions again. So all four, I think, commodities, I think, have shown, I think, very similar possibilities where actually traders do employ calendar spreads to actually take advantage of this. Next, I think I'll touch and go on this, on the intermarket spreads. So actually, what is intermarket, right? So actually, as I said previously, it involves the simultaneous selling. Just basically, right, there's the same underlying asset, but then I think it's two different, it's hosted maybe in a different exchange. So how do you actually determine whether this is an intermarket or actually the commodity spread, or rather is it worth doing? I think the first thing you need to do is to establish a correlation between both products. So I think in the other markets you'll see as well, there's many kinds. There's crush spreads for agri, there's crack spreads for crude oil. In this case, for the LME against Hong Kong Exchange, it can be like a form of arbitrage, depending on how you look at it. Copper, aluminium, zinc, nickel. The principle is actually still the same. They're looking at the spreads, just two different exchanges. You're still trying to catch the mean. So what is the benefit? I think at the end it's the same. You have a lower risk profile as compared to outright. what you're trying to achieve here is superior risk-adjusted returns. So I'll just show you some examples on the LME 3-month rolling forward base metals against the Hong Kong London Mini USD futures. There are certain reasons why we do it. The settlement price, the same underlying asset, and it's conveniently denominated in the same currency, so you don't really need to worry about the exchange rate. So the intention of the spread trader is always to implement a position that reflect the changes in the price difference between contracts. And of course, you need to measure the ratio. So in this case, right, it's easy because it's equally weighted, 1:5. 1 for LME and 5 is the Hong Kong Exchange. So if you look at this, I think a comparison as well, same time frame, June, it's different time frame, June to August. So you see here, right, actually the price tends to flip from positive to negative. This is actually a continuous chart that I pulled out to illustrate my example. You need to look, of course, at the liquid contract months to establish this. So you can see, for example, right, there are times where, it flips up to maybe a positive 100, that is spread, and times it goes down maybe to even negative 100. So I think you see these sharp sub trends, these are actually how traders actually take advantage of this, because what they believe is a reversion to the norm. Traders actually try to catch the spikes of all this, and should see how, how they can actually take advantage of this situation. So the principles, I say, is relatively similar. It's still trying to catch the mean. So for aluminium, right, we see as well, sometimes you see actually prices actually start to, there's a certain spread, a certain difference, but suddenly it starts to close up. And when it closes up, you see traders taking advantage, start to widen back again. And then the same thing. So even you can see over here, this huge spike over here. Everything. So if assuming that 50 is the key point when traders actually see a 68, that's where they might enter the position. But of course, the norm seems to be right here. The line I'll draw as well here, maybe about 30 or 40 for aluminum. So if you look at zinc, I think relatively the same thing. I think zinc looks similar to copper, right? Where there are some anomalies between. I think price flip negative to positive as well. You can see over here, right? As the LME looks to trade, I think slightly higher, but I think the Hong Kong Exchange Mini sometimes for certain reasons they start to trade higher. So that's where I think you can also exploit this situation and make a trade. So nickel as well, you see the same patterns. I think aluminum is the one that I think is doesn't really flip that much, but I think nickel, copper, and the zinc, nickel, copper, and aluminum actually are the ones that tend to flip. Yep. So you can see over here, prices start to move tin. Basically, what you're doing is that you're trading the spread. You're trying to see when it tins, you execute some strategy. When it widens, right, the assumption is that it will close back, revert to the mean. So that is actually trading the basis. It's not so much about trading outright a directional movement of the news. It's more of the price difference. Okay, so I think last thing I'll just sum it up within 5 minutes so we can have the Q&A. So how can actually investors discover prices for base metals in the current marketplace? So of course, as I said, right, well, one of the examples for futures, exchange traded derivative futures, we have the Hong Kong Exchange USD London base metal minis. You have aluminum, zinc, copper, lead, nickel, tin, the full suite. So the asset class is determined by LME. It's the same actually, contract size 5 tons for copper, zinc, aluminum, lead, and 1 ton for nickel and tin. All of them are priced out to 12 calendar months. I think the currency is denominated in USD. Tick size 50 cents and $1. So I think the good thing is that the final settlement price is actually determined by, and the OSP is actually determined by LME before the third Wednesday of the spot month, and it's cash settled. So you don't really have to worry about physical delivery. On the rolling forward side, of course, there is the LME contract. I think that is where you deal with prompt dates. So it depends. So if you're looking at the spread, I think you will look at both contracts. You're looking outright, you can look at both contracts. I think Hong Kong Exchange, the benefit, of course, is it's a mini futurized contract. So I summarized some key points as well to help some of our traders, new traders, why actually Hong Kong Exchange London minis. So of course you see this underlying asset, it tracks the LME, which is actually the global metals benchmark. It's cash settled, you can avoid physical delivery, and you can actually settle against the LME OSP. Mini contract size, of course, 1/5, you have a lot of flexibility there. It's standardized, limited central counterparty risk. You can read off the contract specs, easier comprehension. Asian trading hours for most of our viewers actually is day and night session T+1. This helps to complement London trading hours if you want to. There's actually both denominated as USD and a CNH contract. It allows also arbitraging opportunities. For most of the examples, we are actually using the USD ones. So exchange traded derivatives, why do investors participate? if you look at price action and you want to speculate off market-based consideration, right? Futures always the first responder. You can have a direct play. You can go long, you can go short, bi-directional. Execution cost is affordable and extremely transparent. There's no spreads. I think all you have is you have to pay exchange fee and executional cost to the broker and the platform. Leverage trading, capital efficiencies. You can start off with a minus sum and then you can play off it. It's very liquid and diverse base of clients I shared earlier on. There's commercial traders, there's hedgers, speculators, fund managers, all in the base metal contract. And of course, it's close to 24 hours of trading. There's T and T+1 session. And of course, clearinghouse safeguards from counterparty. It's exchange traded product. This is an example, I think, Phillip Nova. This is how it will look like, for example, if you use Phillip, right, if we issue a platform. It's actually a web-based platform. So how it look like is this, for example, it's a simple illustration. You can view the Hong Kong Exchange, US dollar London prices. You can see the bid ask, the amount of bid volume over here. This is how you will see it. This is actually a demo account that I have. So the account balance is 0. So you can actually pull up a chart or even the order book at the side you can see. So in this illustration, it's actually copper, LME copper. Yep, so this is how it look like if you trade through Phillip Nova. Okay, I think before I end this and move to Q&A, so just leave this. How can we get started Phillip Futures? If you have any questions or you wish to know more or even open an account, you can actually visit this link, or actually you can just write into us. I think we'll do our best to answer. For those of you who are maybe in other countries, we can approach actually the other Phillip group of companies. And actually, the other Phillip group of companies we have in Malaysia, Thailand, Dubai, India. So they can actually help you in your inquiries on if you wish to participate in global futures in Hong Kong Exchange or LME if the jurisdiction allows for. Yep. So basically, this is it. Sri, do you have anything for me?
Not at all, Ben. We're just standing by for the questions to come in. If you have a question that you want addressed by, just head on down to your control panel for the webinar. Go all the way somewhere at the bottom. You will see a question box. Just type them into the question box, and we will address it shortly. Then we have one question. The question is whether we have base metals on ETFs. I'm not too sure about that, but would you like to share the advantages of trading base metals through an exchange?
I think there's a list of industrial base metals ETFs. I think in the US, I remember there's a United States Copper Index Fund. I think, but for us, right, I think Phillip Futures, we don't actually offer ETFs. So the ETF, of course, is a very passive kind of investment strategy. You can actually buy into a basket of base metals. So it really depends. So I think for some of the investors, right, who want to actually place their money and then let it just float, I think our ETFs can always be an option. But for those of you who wish to make a speculative play, you have a certain decision, right? For example, in terms of if you're trading the news and the headlines, so you believe there's a supply shock, I think the fastest way to go in, right, is definitely through the futures market. I think it's very hard to beat because the cost of trading is actually extremely low as compared to ETFs, right, where you maybe have to, where you remove and everything, there's a certain management fee, etc. So I think on the ETF level, I've heard of it, but I haven't really actually studied it. But I think on the futures market, I think we're familiar with the LME and Hong Kong Exchange. I think these are two examples.
All right. We don't have any other questions yet, but I have a question for you. Amongst the base metals which you've talked about today, which would be the one base metal that you think that investors should keep a close eye on?
I think I would name actually, for example, let's maybe go back all the way to technical analysis, right? I think we can actually look at both, I think, copper, aluminum. So for example, I think copper is always very linked towards macroeconomic events. So you can see there's also, and if you look at fundamentals or even trading the headlines, right? I think you can see it's very weighty. On the supply side, there's always China. Sorry, on the demand side, there's always China, and the supply side looks to be in Latin America. So I think with all this geopolitical stuff that's very happening in between the United States and China, this is something that will actually affect prices. So now that we see that there's supply issues with the copper mine production slowing, investing slowing, I think this has helped to provide some support. So if you trade on fundamentals, I think this can be something to look at. Aluminum, of course, is one of the I think benchmark contract. I think it's very liquid, and especially I think in London, it's one of the most liquid. So I think all this, even you can see the volatility and the trends as well, the ability to go up. So I think there's a lot of volatility actually for all four actually, even zinc and nickel, right? I think nickel is uptrend, but I think aluminum and copper, I think these are two contracts. There's a lot of volatility. You can actually trade off it, and actually it reflects for a certain amount of opportunity. Because if the prices stay very stagnant, it's very difficult to actually churn or turn a profit. So I think these are actually two contracts, right, that I think you can really pay attention to, copper and aluminum, if you're trading off prices.
What are some of the key events that we should look out for in the near term, which could impact the prices?
I think on the geopolitical, right, or maybe rather economic event, I think even this week, for example, I think the Jackson Hole is something that people are looking for. I think we've seen, I think interest rates, right, they have been really low, they've really bottomed out. But I looked actually at the CME Fed Fund futures. I don't see anybody pricing for negative interest rates as of late. But I think the Fed is likely to give a very soft response so the market doesn't react negatively to it. Of course, I think POTUS, of course, the election for the U.S. president election is, I think, something to pay attention to. So I think overall, right, I think in this stage, I think if I have to make a prediction, I think the whole geopolitical risk and actually economic uncertainty has actually driven prices up and down. So for now, prices seem to be on the up and up. So I think we should always pay attention. I think if something negative happens, right, then I think the drop and the gyrations in the chart can be massive. It can be actually extremely volatile. So that's what I am looking out for. But that, of course, presents as an opportunity in the futures market where you can not just go long. Like if you buy ETF, you are always long. But if you take advantage of the futures market, right, you can take advantage of a short position or even hedge your exposure on the ETF market.
All right, so the advantages, apart from going long and short, are there any other advantages of trading these metals?
So of course, in the futures market, the capital outlay can be extremely low. For example, like this, in the case of a mini contract, right, the participation you can actually start the participation at 566. So for some of our investors who might not have that kind of capital outlay, and the ability to front up so much cash, right? This can be something to look at. But of course, I've always like to stress, right, that the futures market, because you're speculating off the price action, I think position sizing, right, stop losses and all these are very important. I think it's very important to look at intraday volatility and establish what is the kind of price movement. If the market go against you, you need to have a risk management strategy. That is very important. I think if you go outright, right, and then you actually don't implement a stop loss, right, it can be quite rather detrimental, especially as we've seen in the first quarter where the market was extremely volatile, and most of the people get actually stopped out of their positions in low equity. But on the other hand, of course, it's a zero-sum game. So that is it depends on how you look at it. So I think risk management, I think is key, as I always say.
In terms of liquidity, what can you tell us about these contracts?
Of course, I think if you look at the LME, the aluminum is actually the most liquid contract. I think because all of the first thing is the LME is the whole metals industry in the world globally actually participates in the contract. So I think liquidity is definitely tick on this aspect for LME. On Hong Kong Exchange, it's actually a young growing contract. I think we see trading volumes going up. We see bids and offers. In fact, today I was just paying attention. I saw for the spot month actually, the prices actually, the tick value, the bid ask spread actually 10 to 1 for a period of time. There might be, of course, on the average timing, it might be 3 to 4. So it really depends. So on London hours, of course, when players start to look at both contracts, you tend to see more participation and that tighter spread. But of course, on Asian hours, right, the spread might widen a bit. But I think this is a young contract, it's a growing contract. I think traders should take a look. There might be advantage on arbitraging. There might be also if you don't have that much capital, this is something that you can look at to start your journey on base metals. So I think relatively, I think this is good contracts to look at.
All right, so this is your last chance to send in any question that you may have. Ben, in the meantime, I have one more for you. For these base metal contracts, are there any interesting correlations with other contracts that like traders might be interested in? For example, if I'm trading these other contracts, base metals could be something I should be looking at as well.
I think if you look at it, I think all the you can see this, as I said, these are all industrial metals. I think some people might look at I think, but it's a bit different. So for example, gold and silver, right? We can look at the gold silver ratio, but for base metals, I think it's more commercial, more industrial. Some people might actually tie in copper, right, with economic trends and maybe even the S&P. So far, I've done several tests. I think the best economic indicators that you can look out for is manufacturing PMIs, construction PMIs, imports, exports, something like that. So I think this is closely connected to macroeconomic events. So that's why some people actually trade off the news headlines on copper. That's why you see participation is very strong. So I think correlation wise, I think of course, I think the same underlying is always the strongest correlation between inter exchanges. But I think if you trade off cracks or what, but it's more like a iron ore against steel, not so much on base metals off the futures market. So yep, that is relatively it.
All right, last question for you, Ben, before I let you go. Okay, this question is from Raymond. He's asking, how will Portugal's election affect the metals market? Assuming the Democrats win, what will the impact
Okay, so I think this is a common question. Actually, people are actually asking a lot. If actually the Democrats actually win, right, how does it affect the overall market and price movement? I think what we see from the current consensus is that I think if the Democrats were to take a victory, right, the market looks to be relatively cushioned. But I think, right, more importantly is that as you look as we move towards closer towards the voters, right, how is the volatility? Because if we, from what we see, right, previously as well, there's a lot of rhetoric in the U.S. elections, and it tends to move the markets because people start to think what's going to happen. There's a lot of uncertainty. So I think even before, sometimes I think we take a move, right, in the market, you need to think of the potential volatility. If you are not well positioned, right, or your capital is not enough, you tend to get stopped out. So I think for me, I sometimes, right, I like to look at the charts of the price action from a technical perspective. I think I let the market show me, what is the consensus and where it's moving. So I think if it's me, I will be very prepared actually for more volatility in the coming quarter. I'll be prepared to see, gyrations, and let the consensus through the charts actually tell me, right, how the market sentiment is moving. That's what I would do.
All
Just
right,
my
thank
two
you so
cents on it.
much,
Yeah.
Ben. Thank you for joining us today. And to our wonderful audience, thank you for being part of yet another wonderful webinar with Phillip Futures. All right, do stay tuned for our follow-up email. We'll have the link to the this webinar so you can revise what we have covered today, and also links to sign up for our upcoming webinars on SimSki, Forex, and futures as well. All right, so do look out for our follow-up email. We'll catch you soon at the next webinar. Good night and take care.
Thank you. Take care.